Today we're going to talk about net present value, or NPV for short. In the last episode, we talked about the time value of money and discounting cash flows. Now, with the net present value, we're going to take those two concepts and turn them into the gold standard analytic tool of finance, NPV. Now, what net present value does is take a stream of cash flows going into the future, discount them back to the present value, so we have a value for all of the future cash flows that we're expecting, and then compares that to the cost in today's dollars of what we're going to have to pay to get those cash flows. And that may be an income-producing asset, like, say, a stock or a bond, or something that we have to purchase in order to get those anticipated future cash flows. Or it may be a project that we're thinking about developing, and we look at what are the future cash flows that we're anticipating getting, and then how much is it going to cost us to make that project. And we talked a little bit about that in the last episode. I gave the example of a power plant. And if we were going to build a power plant, it was going to cost us $1 billion to build the power plant, and the present value of the future cash flows were $1.5 billion, then it would be a good deal. If the present value of the future cash flows was $900 million and it was going to cost $1 billion to make, then we would decide not to do that project. And when I say the anticipated cash flows, what I'm talking about are we really don't know in the future what the cash flows are going to be. We make forecasting assumptions about what we think they're going to be, and we can get pretty sophisticated in doing that. But as we all know, whatever we plan for the future is probably, most likely, not going to be the outcome. It may be more, it may be less. It may be more of a success than we anticipated, or it may be more of a failure than we anticipated. The way that we calculate in that type of uncertainty is with a risk premium. So we'd put a risk premium on our discount rate as we're discounting back those future cash flows in order to take into account that risk and that uncertainty. So the other two things that will affect the present value of those cash flows is, one, we just talked about the discount rate. The more we discount things back, the less they're worth in present value terms. The less we discount them, the more they're worth in present value terms. So the higher the discount rate, the lower the present value. The lower the discount rate, the higher the present value. It's an inverse relationship between the risk premium, the discount rate, and the present value. The other two things that we need to take into account are obviously the size of the cash flows. The bigger the cash flows are, the more the present value is going to be, and also how far out in the future they are. The further out they are, the more they get discounted. The closer in they are, the less they get discounted. So that horizon to revenues is the third critical component, the third driver of the present value side of net present value. The other side of net present value would be the costs. If it's a project that we're contemplating doing, then we have an idea about what those project costs are. But as we all know, projects tend to have cost overruns. It's rare that a project comes in on time and on budget. So as a project is delayed and takes more time, and as there's cost overruns, we may have anticipated that a project was going to cost X, and it may end up costing X plus some premium for unknowns that we didn't understand. So a lot of times we want to put some sort of contingencies into the budgeting and forecasting for the costs if it's a project that we're doing. If it's an asset that we're actually going to buy, then it might be a negotiated price, and we know what the cost is for those cash flows in the future. And if it's a structured investment, like a bond or a debt, then we know exactly what those incomes in the future are going to be. The only risk there is if there's a default on that bond and then we don't receive those monies. But the bond payment is supposed to be $100, then that bond payment will be $100. There's no guessing that maybe sales will be more or less, and so the income could be higher and lower than what we were anticipating. So there's those kind of differences in the projects that get analyzed using net present value. But you can see in essence, it's what's it going to cost today and what are we anticipating getting in the future. And if what we're going to get in the future is worth more than what we have to pay for it, then we green light that deal. That's a deal worth doing. And that's a function of, as we said, the discount rate, when those payments are timed to come in, and how much those payments are. So let's go to the segment here and explore net present value in a little more detail. I'll catch you on the other side.